Okay, this part is called FOB, free on board, free on board. So basically, it's about who pays for transportation cost. So there is a seller, there is a buyer. So when the goods or the merchandise are shipped from the seller to the buyer, there is a transportation cost. So there are two shipping terms. One is called a free on board shipping point, so which means the ownership is transferred at a shipping point. So whenever it's the merchandise is out of the door of the seller, then that's the buyer's responsibility to have it transported to buyer's location, transported to the destination. Okay, and there is also a shipping term called FOB destination. So that means until the merchandise arrives at the buyer's door, it's always the seller's responsibility to have it transferred from its own factory all the way to the buyer's place. Okay, so the goods are owned by the seller until it arrives at the buyer. So for accounting part, if it is the shipping point, then the buyer will pay cash for inventory merchandise. Okay, and if it is FOB destination, it's not about merchandise inventory anymore. It is about delivery expense. Okay, it's about delivery expense for the seller. So you have to know the difference. So one is a buyer taking care of the transportation, and another is a seller taking care of the transportation. For sellers, it's a delivery expense. For buyers, it's merchandise inventory. And here we got an example, and this is a FOB shipping point. If it's a shipping point, then you know who take care of the transportation. That's right, it's buyer. So when the buyer takes care of the transportation, then after the buyer pays a $75 transportation fee, then the inventory of the merchandise would build up by $75. Just because you pay more for the inventory on the book, its value goes up. And still, we have the same inventory, we have the same merchandise, the same amount, same quality, same everything. It just the value of it goes up on your accounting book. All right, and here is one itemized cost for the company. So you have an invoice cost of merchandise purchases. So that's how much you had before, but you have to deduct the discount you received, and you also deduct the returns and allowances. So basically that makes your cost reduce. And also you need to add in the cost for transportation in due to FOB shipping point. All right, so you get the net cost for merchandise purchases. It's true that when you receive a discount, when you get returns and allowances, that's some cash inflows. But the whole thing right here is a cost. So the cost is negative, and for merchandise and also for transportation. So in this cost system, all the plus, all the cash inflows are recorded as negative numbers. All right, so here is an exercise. Let's do it together. So here are the activities from October the 1st to October the 31st, and you will see the company purchased $1,000 worth of goods, and here's a term 4% in 10 years for discount, otherwise all net in 30 days. And then on the 3rd, they paid a $30 cash for the UPS or the shipping cost. Remember, this is a FOB shipping point. That means the buyer will take care of the transportation, and that cost will build into merchandise inventory. On October the 7th, the buyer returned $50 of the goods and then receive a full credit for it. So basically, the account payable is reduced. And then 10 days after the purchase, they paid the amount due from October 1st. Okay, and of course, they are not paying the full bill of $1,000. They will pay the $1,000 minus $50. All right, and then we have a different scenario. Okay, so 1, 2, 3, 4. That's one scenario. 1, 2, 3, 5, that's a different scenario. So assume that in October, on October the 11th, the payment was never made. Instead, they paid the due on October 31st. So if they pay beyond the 10 days, then they do not deserve a credit, so they will pay the full amount. So if you look at the merchandise inventory, on October the 1st, merchandise inventory increased by $1,000, and there's also account payable built up for the same amount. And then you will see the merchandise inventory has a debit, that's for assets increase, and then accounts payable also increase, that's for liability, that's a credit. And then you will see on October the 3rd, there's $30 cash being paid, so there will be a increase in merchandise inventory just because you spend more dollar for that product, and the cash is reduced by $30. On October the 7th, you will see the accounts payable is satisfied. Actually, not satisfied. It's reduced by $50 due to a return of our products. So because you return the products, so you have a less inventory, and also on the book, the value of the inventory got reduced by $50. And you also have a $50 less to pay, so your account payable is reduced by $50. All right, so this is what you see on the ledger. And then on October the 11th, you pay the account payable, so all the remaining bill is satisfied. Do you pay this a full amount of $950? No, because you pay within 10 days, so you get a discount. In fact, the cash you only pay is $912. So the $912 come from the 96% or 1 minus 4% of the remaining bill to pay. So the merchandise inventory bear the losses or the deduction of the discount. So that's 4% of the $950. So merchandise inventory is reduced by $38 in value. Okay, so this is how we record for cash discount. And right here, you can get the ledger for all the debits and all the credits. So this is from returns. This is from a discount. So that's a credit. And also for accounts payable is all satisfied to 0. And for October 31st, let's say if this payment on October the 11th did not happen, so instead the company pays in 30 days. So what happens there is accounts payable is all paid off, and the company will use all cash payments. Okay, so cash is reduced by $950. There's no discount at all. Okay, so your merchandise inventory at its value is $980, 1,000 plus 30 minus 50, and also your accounts payables are all gone.